Here is the one fact that explains the whole week. The American stock market is sitting at a near-record high, with the S&P 500 up more than 1% on the day. But it is balanced on a single trade. Semiconductors are now a record 19.7% of the S&P 500, about 4 times their weight in 2020. Nearly 1 in 5 index dollars now rides on the artificial intelligence chip complex. That concentration is the fault line running under the calm. And the cracks under that calm are widening. Bitcoin just fell to a 7-month low, under $59,000, more than 50% off its peak, and its loudest believer blinked. On June 29th, Strategy, the largest corporate Bitcoin holder, authorized selling up to $1.25 billion of Bitcoin to fund a preferred dividend it just raised to 12%. The never sell doctrine is dead, and the company's market value has fallen below the Bitcoin it holds. When the premium that powers a flywheel disappears, the flywheel reverses. So where's the edge? Not in the crowd. The artificial intelligence boom has even become an inflation input. Researchers estimate that surging memory prices have added about 30 basis points to core inflation, which keeps the Federal Reserve hard line and drains everything with a long duration. The discipline is to own scarce, self-funding cash flow, like Micron, printing record cash at an 85% gross margin. And to avoid anything priced on a premium or a promise, the crowd is long the fault line. The evidence says own the cash, not the premium. This is the asymmetric. This is the asymmetric, issue 32, the fault line, tech and crypto investing for thoughtful retail from an operator's lens. Last issue named the force now setting the price of every asset, a Federal Reserve that has stopped catching the market. This issue names the fault line that hard line has exposed, a near-record market balanced on one trade. Here's the one-line read. Equities ran risk-on into month-end on the Middle East calm rotation, with the S&P 500 up 1.18%, the Nasdaq 100 up over 2%, and volatility bleeding lower. But the index is now a leveraged bet on one trade. Semiconductors are a record 19.7% of the S&P 500, about 4 times their 2020 weight. Beneath the calm, 2 cracks widen. First, the artificial intelligence boom became an inflation input. Researchers estimate memory prices added about 30 basis points to core inflation, so the trade now finances the very inflation that keeps the Fed hard line and drains long-duration assets. The yen fell to a 40-year low, gold is pinned near $4,000, and Bitcoin hit a 7-month low under $59,000. Second, the high beta tail's loudest believer blinked. On June 29th, Strategy authorized selling up to $1.25 billion of Bitcoin, built a cash reserve, and raised its preferred dividend to 12%. The never sell doctrine is dead, and its market value has fallen below the Bitcoin it holds. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, a record index on a single fault line. 30-second frame. 1. The index is narrow. Semiconductors are a record 19.7% of the S&P 500, about 4 times their 2020 weight. 2. The melt-up is rotation-driven. The S&P rose over 1% and the Nasdaq 100 over 2 on the Middle East calm rotation. 3. The artificial intelligence boom now feeds inflation. Researchers estimate memory prices added about 30 basis points to core inflation. 4. The drain continues. The yen hit a 40-year low, gold is pinned near $4,000, and Bitcoin made a 7-month low under $59,000. And 5. The eased geopolitical tail is the bid. United States and Iran talks resumed in Doha, and oil drifted towards $70. Start with the fault line itself. Chip stocks have climbed to a record 19.7% of the S&P 500's market value, roughly 4 times their weighting back in 2020. The artificial intelligence rally has concentrated index returns into a single complex: NVIDIA, Broadcom, TSMC, AMD, and the memory makers Micron and SanDisk. To a first approximation, the S&P is now a leveraged bet on the chip cycle. This is not a forecast of a crash. Concentration can persist and even extend. But it changes the character of index risk. Broad index investors now own far more of one trade than they realize, and a single sector drawdown, a capital spending wobble, or a memory price crack would drag the whole index disproportionately. The same week, Micron reported a blowout quarter, revenue of roughly $41.5 billion, more than quadruple a year ago, at a gross margin near 85%, with the stock up about 15% after hours. Breadth, not the headline level, is the tell. Now the most underappreciated link in the regime. The artificial intelligence boom has become a macro problem, not just a growth story. Researchers at Wolfe estimate that the surge in memory prices has added roughly 30 basis points to core inflation, the Fed's preferred gauge. The mechanism is direct. High-bandwidth memory commands 2 to 3 times the price of conventional memory, and those costs are passing through to retail electronics. So here is the loop. Artificial intelligence spending bids up memory, memory lifts core inflation, a hawkish Federal Reserve stays hardline, and the higher-for-longer rate keeps draining the long-duration, financing-dependent assets, the yen carry, gold's haven bid, the crypto complex. The trade is, in effect, financing the inflation that caps the rest of the market. The consensus says artificial intelligence is disinflationary over time. Our variant, eventually. Perhaps, but in the near term, the hardware build is inflationary, and that near-term print is what the Fed reacts to. Macro 3, the drain, and the ease tail. The yen, gold, and Bitcoin all tell one story. The price of money is high and staying high, and the longest duration, most funding-sensitive assets pay for it first. The Japanese yen fell to 162 and change per dollar, its weakest since 1986, a 40-year low, breaching the zone that prompted intervention in 2024 and putting traders on fresh alert. Gold trades near $4,000, pinned by a firm dollar and high real yields, and Bitcoin made a 7-month low near 59,000, more than 50% below its peak, the high beta corner of the same drain. The one offset, the ease tail. United States and Iran negotiations resumed in Doha, easing the war premium, and crude drifted towards $70. That de-escalation is the rotation bid under equities. But the risk is asymmetric. The downside in oil is gradual, while a breakdown or a Hormuz scare reprices the entire risk complex instantly. Part 2, in focus, the premium breaks and the never sell doctrine ends. The in focus name is strategy, ticker MSTR, formerly MicroStrategy, and the move is a regime change for the entire Bitcoin treasury model, straight from the filings. On June 29th, Strategy filed an 8K announcing a 5-part capital framework that fundamentally rewrites how the largest corporate Bitcoin holder funds itself. 1. A Bitcoin monetization program authorizing the sale of up to $1.25 billion of Bitcoin. 2. A cash reserve of $2.5 billion, with board policy requiring at least 1 year of dividend and interest coverage at all times. 3. A raise of the preferred dividend to 12%. And 4 and 5, $2 billion of buybacks. Strategy holds roughly 847,000 Bitcoin. And here is the crucial number. Its market value relative to its Bitcoin has fallen below 1 versus a peak near 4 times in late 2024, meaning the market now values the entire company at less than the Bitcoin on its balance sheet. Now the mechanism, when the premium dies, the flywheel reverses stage by stage. Stage 1, it ran on a premium. The whole model depended on the company's market value being above the value of its Bitcoin, issuing common stock above that value, and using the proceeds to buy more Bitcoin per share. The premium was the engine, not the coins. Stage 2, the premium inverted, with the market now pricing the company below its Bitcoin. The accretive equity engine is dead. Strategy can no longer issue stock above its asset value, yet it carries a 12% preferred dividend obligation it must fund. Stage 3, so it must sell the asset. The only lever left is to sell Bitcoin to pay the coupons, exactly what the $1.25 billion authorization enables. A perpetual holder becomes a structural seller into a falling market, the textbook forced seller dynamic. The asymmetry, the premium broke, not the asset. Bitcoin's structural case is intact. What failed is the levered, premium-dependent wrapper built on top of it. The debate, the bull. This is disciplined liability management. The framework builds a year of cash coverage for a growing dividend stack. adds buybacks while the stock trades below the value of its Bitcoin and reserves the Bitcoin sale as a funding tool, not a capitulation. Authorization is not a sale. If Bitcoin re-rallies and the premium climbs back above 1, strategy can resume issuing equity at a premium and the flywheel restarts. The model depended on that premium, and with it inverted, the engine is broken in reverse. A 12% obligation must be funded, so the only lever left is selling Bitcoin to pay coupons. A never seller turned potential seller of more than $1 billion into a falling market is the forced seller dynamic. And with Bitcoin near 59,000 against a cost basis in the mid-60 to mid-70,000s, the holdings now sit at or near break-even for the first time. The referee is the premium and whether strategy actually sells. The read, a research view, not a call. Strategy is the purest expression of this issue's fault line. Its value was never just its Bitcoin. It was the premium the market paid over that Bitcoin, a premium that depended on cheap money, a believing market, and a one-way asset. The hardline Fed drained all three, the premium inverted, and a never-sell holder became a potential seller of more than $1 billion. The same force that makes a 19.7% semis index fragile and turns artificial intelligence spending into an inflation headwind shows up here as a collapsed premium. Concentration, leverage, and premium dependence all break first when the price of money rises. What would change the read? Bitcoin re-rallies, the premium reclaims above 1, and strategy executes no meaningful sales. The flywheel restarts versus executed Bitcoin sales with the premium stuck below 1, the forced seller dynamic confirmed. Step back and the three fault lines are one fracture. A record index built on one trade, an artificial intelligence boom that finances its own inflationary headwind, and a treasury model whose premium has inverted are not three separate stories. They are concentration, reflexivity, and premium dependence, and a liquidity drain finds all three first. Concentration. Semiconductors are a record 19.7% of the index, so a single sector drawdown drags the whole market. Reflexivity. Spending bids up memory adds about 30 basis points to core inflation, and the print keeps the Fed hard line, the trade financing the inflation that drains it. And premium dependence. Strategy's market value fell below its Bitcoin, forcing a never seller to authorize a sale. The discipline is to own the one side a drain does not find: scarce, self-funding, present tense cash flow. And the thematic: own self-funding scarcity and avoid premium dependence. The hard line is draining everything priced on a premium or a promise, while the input the world is short of keeps printing present tense cash. So own the scarce, sold-out input, the memory bottleneck with contracted demand and self-funding cash, reinforced by that record semis weight. Own the self-funding cash machine, the hyperscaler that funds the biggest build on Earth from operating cash flow. The durable margin software compounder and scarce baseload power. Own the rails and the absorber, the cash-generative tokenization rails, and the toll collector that earns on the crypto absorption either way. And be wary of the premium and leverage complex, the Bitcoin treasury wrapper whose premium inverted, the crypto high beta tail at a 7-month low, the carry-funded yen, and gold's haven bid pinned on the dollar. The discipline is not sell tech or sell crypto. It is own the cash, not the premium. Part 3, the fault line: own the cash, not the premium. What we are watching over the next 10 days, the United States data week, manufacturing surveys, and the jobs report, which sets the Fed debate. The United States and Iran talks in Doha, a breakdown reprices oil and risk instantly. Strategies preferred dividend stepping to 12% on July 1st, which sharpens the Bitcoin monetization pressure. The next inflation print, with about 30 basis points of memory-driven inflation embedded in it. The yen near 162, the intervention tripwire. Bitcoin's 59 to 60,000 line, and whether strategy actually sells. Market breadth against that 19.7% semis weight, the concentration tell, memory pricing, and the hyperscalers' spending plans, daily spot Bitcoin fund flows, and Micron's next quarter against its $50 billion guide. And we keep score in public. Strategy enters as the inverted premium, its market value below its Bitcoin, the never sell doctrine dead. The macro theme: concentration, semiconductors at a record 19.7% are the fault line. The artificial intelligence theme: chipflation, Capital spending is now a self-reinforcing inflation input. Crypto, updated, a liquidity drain capitulation, not an impairment. And carried forward, Micron. The sold-out memory bottleneck, the hard line, the binding cross-asset constraint, BlackRock, the toll collector, Alphabet, the self-funding compounder, and gold, cited by level and driver. Dated, falsifiable calls, and we grade them. So where does it land? A near-record market is balanced on a single fault line. Semiconductors are now a record 19.7% of the S&P 500, about 4 times their 2020 weight, so nearly 1 in 5 index dollars rides on one trade. Beneath the calm, 2 cracks widen. The artificial intelligence boom became an inflation input, about 30 basis points of core inflation, so the trade finances the very inflation that keeps the Fed hard line and drains the yen, gold, and Bitcoin. And the high beta tail's loudest believer blinked. Strategy authorized selling up to $1.25 billion of Bitcoin and raised its dividend to 12%, and its market value has fallen below the Bitcoin it holds. When the premium that powers a flywheel disappears, a buyer of the asset becomes a seller of it. The discipline that survives a fault line regime is to own scarce, self-funding, present-tense cash flow and to avoid anything priced on a premium, a promise, or the single most crowded trade on the board. The crowd is long the fault line. The evidence says own the cash, not the premium. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.